Thanks, and thank you for having me this morning. I mean, in our world, in pensions world, in gilts world, as you say, the finances here are not really moving the needle. Okay, I mean, if you compare this to the energy cap, where we have expected to load 150 billion pounds worth of gilts into the gilt market, the broader mini budget package where we were thinking, let's put 70 billion pounds worth of unfunded, as tax cuts, etc., into the markets, that 2 billion, 5 billion, whatever the actual number is, at the 45% level is pretty small, right? But what it does show, it's symbolic. And it's almost, if I look at the reactions that markets were taking in the past week, markets were already going apoplectic on Friday after the mini budget. And when markets saw the interview on Sunday, where the Chancellor said there's more to come, paraphrasing here, but there is more to come, that's what was starting to really, really scare the markets. And from my client's perspective, as massive gilt holders, they're thinking, like, is anyone watching this? Is who's watching what's happening in our market right now? Because it's carnage here. So as you say, symbolically important. The bank's gesture last week again was massively symbolic, and what our clients, the pension funds, are doing now is they're using any breathing space they can get to really stock up, replenish, and repair their portfolios from the damage that's happened over the past week or so.
Let's talk more about the damage that occurred last week, which prompted the Bank of England to act, as you mentioned, with these special liquidity operations. Many people are reporting that pension funds look like they were on the brink, but again, if you look at the detail there, it seems to me that this was more of a liquidity issue than a solvency issue. Because rates were so much higher, the value of the liabilities had dropped. So actually, a lot of these pension funds were in a decent shape from a solvency perspective. The issue, of course, is that we had this major sell-off in gilts, and the pension funds were not able to meet the margin calls quickly enough. So can you just describe to us exactly what went down with the pension fund community on Monday and Tuesday last week, and how bad it was?
Sure. No, great question. And you have hit the nail on the head. This was a liquidity crisis. It was a gilt market crisis leading to a liquidity crisis for pension funds. It wasn't a solvency crisis. As you've said, the pension funds are holding the gilts, they're holding the liability-driven investment, LDI funds, as a hedge against their liabilities. So all of last week, you had gilt yields going up, 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 up. Liabilities are coming down. So this should have been a great story. And even as early as the Friday of the mini budget, you had this almost dream scenario in some ways for pension funds, where their liabilities were just coming down so quickly. They were getting so much better funded, and really quickly that dream turned into a nightmare for the pension funds, because it was becoming very, very clear that this market is designed for money to be moved over days, weeks. The typical collateral call for these LDI funds is due to take maybe 5 days. Pension funds literally could not get the money from where it was into where it needed to be quickly enough, and all the time the market was effectively like eating itself, right? You had this, some people have called it the doom loop, some people have called it the death spiral, where pension funds are effectively, to meet collateral calls, they're selling more gilts. They're putting more gilts back into the market. And you just had this spiraling effect where effectively it was hard to see where the floor was until the Bank of England stepped in.